Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about NCPL, Net Capital Inc. This is a stock that has become pretty much synonymous with extreme volatility. It's trading right now around that 85-cent to $1 level. And you just have to look at the recent action. On December 8th, 2025, the stock fell over 21% in a single day. And that was fueled by these intense trading volumes approaching 500,000 shares.
And that volume tells a really fascinating, but I would argue a very dangerous story. If you look at the FINRA data from that December 8th drop, it shows that over 37% of the trading activity was off-exchange short volume. Now, contrast that selling pressure with the spike we saw earlier in the month, specifically December 1st, where the stock rallied almost 30% against a short volume ratio of over 63%. These kinds of massive frequent swings, they aren't the sign of a stable business. They indicate a stock being driven almost entirely by market structure.
Precisely. And that oscillation really forces us to address the core tension with net capital right now. The question is this a legitimate, albeit deeply distressed, fintech company that's successfully executing a strategic pivot towards sustainable revenue? Or is it fundamentally just a non-viable financial engineering vehicle, one whose structural reliance on massive dilution just perpetually annihilates any long-term shareholder value?
It's impossible to separate the two. You can't separate the operational side from the financial mechanics.
I see the operational shift as the only real path forward. My position is that NCPL's strategic shift in focus is a critical, absolutely necessary step to generate high-quality cash flow. And this provides a potential call option for investors who are willing to take on the risk, the ones who believe management can actually transition the business before the cash runs out.
I come at it from a completely different angle. The company's precarious solvency, which is, it's defined by an imminent going concern warning from its own auditors. That and its catastrophic history of dilution suggest the stock is fundamentally just a high-variance trading instrument. It's driven by technical forces, not fundamentals. The operational pivot is frankly a hopeful side note to the existential financial crisis the company faces every single day.
Well, let's detail that pivot because it's management's direct response to an acknowledged failure. For years, NCPL struggled with what we could call the paper revenue problem. They were booking revenue primarily through equity-based consulting, so they were taking stock, not cash, for their services, which of course means they couldn't use that revenue to pay their own bills.
It was a structurally flawed model from the start.
Absolutely. So the pivot involves ceasing that illiquid consulting entirely and focusing everything on Net Capital Securities, Inc., their registered broker-dealer. The goal now is to capture cash-based placement and success fees from companies trying to raise capital. This shift to a repeatable, cash-generating, fee-based service is the single most critical action the company has taken to, survive.
Okay, I acknowledge the logic there. The pivot was necessary. But we have to talk about the cost of initiating it. You point to the reported $4.56 million cash balance as of July 31st, 2025, and you call it an optical improvement from the, $289,000 they had before? But that cash didn't come from successful operations. It was almost entirely funded by the $8 million they raised through massive, and I mean massive, dilutive offerings in July 2025. They got the money by selling equity at depressed prices.
But they are actively fighting for solvency, and securing at $8 million, that demonstrates their ability to raise capital even under incredibly difficult conditions to fund this transition. This isn't just financing, it's survival capital. They bought themselves the runway they so desperately needed.
Runway is the key word, and that runway is terrifyingly short. I'm sorry, but I just don't buy that the financing buys them enough time. Let me tell you why, using their own Q1 2026 financials. In that same quarter, the company posted a net loss, that's the cash burn, of $3.64 million. Now, if we just run that number against the $4.56 million they have on hand, the implied cash runway is barely 3.8 months.
That is a harsh calculation.
It's a mathematical reality. That 3.8-month period isn't a transition. It's a drop-dead date. Management is trying to run a marathon on a 100-yard track. This necessitates perpetual aggressive dilution starting, early next year? It makes the whole pivot conversation secondary to their immediate financial crisis.
So the burn rate is terrifying, I get it. But the only way they survive that burn is by going back to the well. And that brings us to the most painful part of this whole story, the mechanics of dilution and the cumulative value destruction.
Indeed. And the aggressive financial engineering, it just confirms that NTPL is primarily a vehicle for capital redistribution. It transfers capital from retail investors to fund operations, not to create shareholder value. We need to actually put a face on this carnage by looking at the pure mathematics of their reverse splits.
Let's do that. Let's detail the cumulative impact for everyone listening.
Okay, look at the sheer scale of these consolidations. You have the 1-for-2,000 split in November 2020. Then you have the 1-for-70 consolidation in August 2024. Now, if a dedicated investor held, say, 140,000 shares of the predecessor company, Value Setters, back in early 2020, through those two splits, their entire position is systematically reduced to exactly 1 share today. That is the definition of shareholder annihilation, and it's driven entirely by the need to stay on the NASDAQ above that $1 minimum bid price.
That's an interesting point, though. I would frame it differently. I acknowledge the profound harm and, frankly, the resentment this history has generated. But focusing only on the past, it obscures the present reality that these splits, they weren't necessarily malevolent. They were a painful necessity to create headroom in the authorized share count.
Headroom to liquidate more equity?
Headroom to raise capital to fund the operational pivot. After the split in August 2024, the outstanding share count was only about 500,000 shares. They then leveraged that to the maximum to raise the $8 million we discussed. This caused the outstanding share count to balloon to 4.7 million by July 2025. That's an 800% increase in dilution, but it was the necessary cost of staying listed. It was that or get delisted to the opaque OTC market.
But the structural imbalance just ensures this cycle repeats. The business model dictates that for every $1 of revenue they generate, they spend roughly $13 in operating costs. That is the fundamental disconnect. This structural imbalance ensures the company must dilute at an aggressive rate just to tread water. They're constantly resetting the share count with reverse splits to avoid delisting, only to flood the market with new shares all over again. The issuance is necessary, yes, but it's necessitated by a non-viable cost structure.
I concede the cost structure is brutal, but management's actions suggest they know about the impending financial catastrophe, which is why we need to shift focus to the market mechanics themselves. The stock's price action seems to be dominated by forces outside of the balance sheet. I mean, the low float, around 4.7 million shares, it creates this extreme technical volatility, making it a high-variance trading instrument.
That's a compelling argument, but have you considered the full implication of that market structure? The volatility is, it's a managed volatility. We have to clearly differentiate between two concepts here: short volume and short interest.
Okay, clarify that for the audience.
So short volume is the high-frequency transactional noise you see every day. It's the volume of shares sold short and then covered very quickly. Short interest, on the other hand, measures the aggregate number of shares held short by long-term skeptics, and that sits relatively low, around 5.2%. The massive daily short volume you point out, like that 63% on December 1st, it isn't evidence of a massive short bet. It's evidence of market maker activity.
And why is that distinction so critical for NCPL?
It tells us that the volume is being systematically managed, primarily through dark pools. Think of it this way. A retail investor hits the buy button on their app. Now, instead of that order hitting the public lit exchange and pushing the price up, a large market maker, a wholesaler, internalizes the order. They sell the stock directly to the retail buyer from their own inventory or by shorting it, and then they hedge that position later.
So the retail buying pressure just gets absorbed.
Exactly. The high off-exchange trading volume is systematically designed to dampen true price discovery. The market makers are shorting shares to fill the retail demand, which prevents the price from running. This structural friction is why retail buyers get so frustrated. Their buying pressure is just systematically absorbed, making a sustained, catastrophic short squeeze highly, highly improbable. The structure protects the wholesalers, not the shareholders who need open price discovery.
I accept that the price discovery is opaque. It's frustrating. But the only way to overcome that structural friction is through true operational success, generating real cash that can overwhelm the dilution cycle. And that brings us to the immense execution risk of this pivot.
Which is enormous, and it's all laid bare in their financials. My focus here is the severe operational weakness that's revealed in their revenue for Q1 2026. A stunning 73% of Net Capital's total revenue came from a single issuer. This is not diversification. It is an existential counterparty risk. If that one client leaves, the entire revenue base collapses instantly. And that accelerates the need for new, dilutive financing far sooner than even that 3.8-month runway suggests.
This is precisely why management's actions, however optically dilutive they seem, they must be seen through the lens of highly incentivized growth. Look at the December 8th inducement grant of 1 million restricted shares to a new high-level executive. That is 21% of the entire float used to hire top talent.
It's a massive expense. They're essentially paying in company currency because the cash just isn't there.
I'm not convinced by that line of reasoning because the incentive structure targets the exact concentration problem you just described. Those shares only vest if the company hits specific revenue targets, scaling up to $1.5 million. This aligns new leadership with the singular goal of generating high-quality cash revenue through the broker-dealer model. That is the only thing that can save the company from the dilution trap.
But let's put that vesting target in context. For a NASDAQ-listed company supposedly undergoing this massive transformation, a $1.5 million target is alarmingly low. The company's trailing 12-month revenue is already around $917,000. Setting a 100% vesting target at $1.5 million suggests the board has vanishingly low expectations for any meaningful growth. They are rewarding marginal revenue increases with massive share grants, which just confirms the emphasis remains on equity transfers, not ambitious operational scaling.
I agree, the bar is low, but hitting that bar with cash revenue instead of the old paper revenue is the fundamental existential difference here. It proves the shift is actually generating what they need to service their debts and operating expenses. The race against the clock is very real, and they are using the only currency they have, which is equity, to buy the expertise they need to win that race. It's a desperate, but it's a focused strategy.
The desperation is evident. The company's future is just dominated by the mathematics of capital raising and NASDAQ compliance. The stock price is determined by the need to stay above that $1 minimum, which will inevitably lead to another painful reverse split if the burn rate continues to outpace new cash revenue. The pivot is a necessary dream, but the dilution is an unavoidable mathematical reality given the current structural costs.
I acknowledge the severity of the risks, the going concern warning, the revenue concentration, the imminent dilution overhang, all of it. My summary is that the value proposition of NCPL is purely an operational call option. It's a high-stakes bet that the new broker-dealer model can achieve critical mass and generate enough cash flow to outpace that severe burn rate before the 3.8-month runway expires. The risk is extreme, but the potential reward, should the pivot succeed, is all tied to management execution.
And I'll reaffirm the structural view. The company's financial history, defined by those 1 for 2,000 and 1 for 70 splits, demonstrates this is a financial engineering vehicle first. The stock remains a high-variance trading instrument driven by technical dynamics, dark pool structure, and the constant overwhelming threat of more dilution and more reverse splits, not by fundamental value creation. It really just highlights how profoundly complex these microcap markets are, where market structure can dictate price far more than the underlying business operations.
Our analysis has highlighted the deep tension between NCPL's strategic operational shift toward cash-based revenue and its fundamental financial instability, marked by extreme dilution and these high-stakes market mechanics.
a truly precarious situation. It demands a critical analysis of both the balance sheet and the mechanics of the trade itself.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.